Kathy Wood is a name that I'd say she's pretty famous in the investment community. I started hearing about her about 2 years ago when the tech market was peaking, maybe, a year and a half ago. And there were a lot of articles circulating at the time about how Kathy Wood was the next Warren Buffett, right? So if I see something like that, I usually take notice. And
I think Kevin O'Leary was the next Warren Buffett.
everybody's the next Warren Buffett when they have a good year, right? Even though their investment strategy has nothing to do with Warren Buffett. But anyway, she's back in the news.
She couldn't be farther from that Warren Buffett strategy in terms of her strategy.
Couldn't be further. Could not be further.
Sorry,
but yeah,
sorry.
but so she's back. That's all right. But she's back in the news. I came across a couple news releases mentioning Kathy Wood last week, and what this is all about is BMO Investments launches new funds with ETF series managed by ARK Investment Management. So ARK Investment Management is the investment management firm that Kathy Wood runs, and her main flagship ETF is the ARK Innovation Fund. So basically, this is an ETF that invests in what she believes are some of the most innovative companies in the world. So companies that are bringing technologies essentially that will change the world, or which she thinks will change the world. So that's what the fund is based on. Why is this news? Why does anybody care that BMO is launching some new funds with Kathy Woods? Well, the reason for that is because, according to Bloomberg, Kathy Wood's ARK Investment Management has had the worst performance year to date, at least as of June 1st, compared to any other major top ETF in the United States. So this is the top 25 ETFs in the US, of which Kathy's ARK Innovation Fund was a part. And according to Bloomberg, that fund has had the worst performance. So what do they say here? ARK's lineup holds $15.3 billion across 9 ETFs, a 48% decrease from the start of 2022 as of June 1st. So this is actually, I believe that the fund is down about 66% now. That's the biggest collapse in assets amongst the 25 largest US issuers. So this is what her flagship fund looks like. Absolutely went haywire in 2020 and in the first part of 2021, or leading into 2021. And then since then, it's been catastrophic for investors. So the fund is down 75% from its peak in about a year ago. And I believe it's down about 65% more or less. Somebody can check the numbers year to date. So the question really is, if she has the worst performing fund amongst the top 25 ETFs in the US, why is BMO starting new funds with her? Like, why is she being rewarded with new funds? Well, I can kind of get the mentality here. So she's a technology innovation investor. Now, any investment manager who is tech heavy a year ago is going to have really poor performance. I mean, we've gone over the tech sector in the US, software companies, especially the high growth SaaS software style businesses, the ones that were considered the most innovative companies in the world, have had the worst performance. So just as an example, Zoom, everybody used Zoom. It was critical infrastructure during the pandemic. That stock is down about 85% from its highs a year ago, right? So anybody who has invested in these types of companies is going to perform poorly. So I can understand the mentality of, well, now, with so many of these companies down, 60, 70, 80, 90% even, maybe now is the time to start investing in them. But I think that's too simplistic an approach. I want to actually see what she's investing in and take a look at her investment abilities from that perspective, and maybe talk a little bit about the risks. So top 10 holdings in the ARK Innovation Fund, right up at the top of the list, Tesla, Zoom, the top 2 companies. Now, these are legitimate companies. I mean, Tesla, certainly not my favorite stock, not something I would invest in, but they are generating profit, good revenue growth. Zoom's another one. That was the pandemic boom story. It's down, like I said, about 85% from its highs about a year ago. But they're generating earnings right now. Earnings have come down, but once they bottom out, you're looking at good potential for the stock to start to recover from there. But what about the other companies? So we have 8 other companies on this list, and what do they look like? So I went through these companies just to take a look at the fundamentals to get a good picture of the types of businesses that this fund is invested in. And what I see is just the general trend here is that there is no focus whatsoever on profitability and cash flow in these investments. So Roku, okay, they burnt about 21 million in cash flow over the last 12 months, not a big deal. Intelia burnt about 300 million. CRISPR burnt almost $500 million. Going down to the bottom of the list, you have a couple companies here, Block, Teladoc. They actually did generate positive cash flow. That's good. And then there's Coinbase, which is a crypto company. They burnt 1.8 billion over the last 12 months. So there's obviously a clear pattern here. And that's that this fund is not investing in companies that are generating profitability and cash flow. And if I were to look at just say these six companies that are burning huge amounts of cash flow from the top 10, they account for just over 50% of the top 10 holdings. I'm going to assume as we go down the list into the other companies, although I haven't actually looked at them myself, but I'm going to assume that profitability isn't much of a focus in those names either. So we can pretty safely make the assumption that 50% or more of the companies that she's invested in are burning through a lot of cash flow. Now, why is that a problem? I mean, people know that, a lot of these innovative companies, they have to burn cash in order to invest in their business, in order to grow over time and take advantage of these opportunities that they have. But there is a problem with this, and it's something that anybody who invests in the fund needs to take into account in this particular market environment. All of these companies have been absolutely smashed in the stock market. I haven't gone through the individuals, but like I said, Zoom down 85%. 70 to 90% is not at all unusual in terms of declines for these companies. So the ability to raise money by selling shares in this market is extremely limited. And if you're able to do it, you have to issue a lot of shares to raise what is a relatively small sum of money compared to what you could have done a year ago. Debt is not really a great option either, because most creditors don't want to lend money to companies that are burning through a ton of cash flow. And cash flow is the lifeblood of the business. Every company needs cash flow in order to survive. You have to pay your suppliers. You have to pay your rent. You have to pay your employees. So the cash flow has to come from somewhere. Now, if a company is generating positive cash flow, they can deal with a challenging market like this for a longer period of time because they are not under pressure to go back to the market or go to the bank in order just to fund their business's survival. But when you're losing $500 million a year, almost $2 billion a year, at some point, unless you can turn that business around and start to generate significant free cash flow, you're going to have to get that money from somewhere. So either you're going to have to raise that money at ridiculously high rates, which is usually extremely dilutive to existing shareholders, or you're just going to go out of business because you can't raise any money. And this is the big risk that I see with a fund like this. Now, if we enter into 2023, the economy looks good, inflation comes down, rates don't continue to increase or interest rates come down, everybody gets happy again, I think that a fund like this could do really well, and from a speculative perspective. But if this bear market lasts longer, if we're looking at like a 1 to 2 or 2 to 3 year recession or bear market, and I'm not saying that that's what we expect, but if that happens, I'm expecting that some of these businesses are just going to cease to exist. Now, they won't necessarily go bankrupt. They may sell themselves for a pittance to another company, but for existing investors, that's really a moot point. It means they're going to suffer almost 100% loss, or at least a very large loss. And this is the main risk that I see from Cathie Wood's fund. Now, she made a statement here in the press release issued by BMO. She said, "We believe that in the global equity market, truly disruptive innovation is priced at roughly $7 trillion. We believe that number is going to $210 trillion in 2030.
Can I just say, isn't it nice to be able to pull figures out of your butt?
I would love
like
to
honestly,
just be able
like
to do that.
what the heck? Where does that figure come from? Like,
I would
for
love
the
to know.
love of God.
Because like so this would mean it's going from less than 10% of the market. But oh, it's a beautiful marketing statement. Because people are seeing the opportunity. But the more a company markets or an investment manager markets, the more you have to be cautious. right? So she's saying, so it's going, these highly disruptive industries are going from less than 10% of the market to more than 50% of the market by
Okay.
2030. So this
Yeah.
is, about 7 years from now, they're going to be 50% of the market.
Yeah.
And that
Yeah.
includes, relative to all energy stocks, relative to all industrial stocks, real estate, just about every other business you can think
It's
of.
gonna
When I
happen.
start,
Don't
yeah,
even.
when I start computing the numbers in my head, I'm thinking this might be just a little overly optimistic. Now, I have no doubt that some of these companies can, if they survive the market downturn, go on to do some pretty great things. But when I look at the construction of her fund, I have to think. I mean, we analyze software stocks ourselves, some of the most innovative companies in the world, but companies that are also generating a lot of free cash flow, companies that are in the space of AI, automation, cybersecurity, cloud computing. These are innovative companies that are traded the world too. The difference is they're changing the world, but they're actually making money while they're doing it. And these are the companies that I'm not worried about over the next 2 to 3 years because they don't need to go to the market to raise money. So my question is just, why don't we see more of these names amongst the top 10? Um, and I'm not going to make any prediction as to where ARK Innovation is going to go. I'm just going to say the risk is extremely high. This fund could end up doing really well if the market recovers, interest flows back into tech, and the economy is good. But if we're in for a prolonged recession, some of these companies are going to have some real problems, and the downside on ARK Innovation is likely far from over in that scenario. We may just be seeing the beginning, depending on what happens with the economy. So, for anybody who loves this type of investment, once again, it's not that you can't put your money in these types of companies, but understand what you're doing. Understand it's really a speculation. And you need to make sure that you limit the amount that you invest in these profitless businesses, cash flow burning businesses, limit it to the amount that you can afford to lose.
Yeah, I mean, I did a speech earlier this year and spent 5 to 8 minutes in it on the ARC Innovation Fund as a warning that this is after it was down 45% at that time in early February, and I went through what Aaron did there. I went through the top 12 holdings, and on a price to sales basis, the valuations were ridiculous. I think there was one company perhaps that had cash flow or earnings in Coinbase at that time. I think that was pulling out Tesla from the mix, and it just like the stock it was at 72 now, and what is it at today? Or the ETF, sorry, it's 35. It's gone in half again from
Mm-hmm.
then.
Mm-hmm.
Still, the valuations on the top 12 holdings, they're still not expressively cheap. Like they're not even close to that, and some of them don't even have earnings. So I mean, just
Another
you know
issue yeah, no, finish. Sorry, and
Well,
I'll
I mean,
go
I
ahead.
would just say you're still not buying at anywhere close to being blood in the streets, and the company went down almost 50%, then went down another 50% from there. You'd think that this fund was then trading at levels that must be make it extremely cheap, and its constituents within it are extremely cheap. That's not the case here. This this company, and Aaron talked about it, what it needs for this fund or a new fund in this segment to start going again is rosy markets. Like that is not what you should look for when you are investing in any type of investment. We need really positive markets, then this stock will do well, or then this investment, this fund will do well. Have a company or a base of companies that can do well, and have some resiliency in most market conditions. And in this case, I don't think you see that. And I think the discipline is just is such you've picked the word innovation, and you've then espoused this moniker on companies that you think are innovated, and you haven't had any discipline to the fundamentals of the business, and that's why you've already destroyed the capital within this fund over the past several years. You need such a recovery in this fund to then gain back anybody's money who has invested in it over the past several years. And I think we look back at now, this had a tremendous track record over a 4 or 5 year period. I mean, do you have the figures over the last 4 or 5 years
Yeah, I
on this
looked at
fund?
them. So if you go back to 2014, the which is when the fund was initiated, the average return annually is about 9.5% per year. So it's still a positive return, but that puts it on about par with the S&P 500.
Yeah, I
And
think
if
the
you put the two
NASDAQ,
charts,
though, has crushed it
yeah.
over that period, has it
And I'm
not?
just,
Like,
no, yeah, the NASDAQ has, I believe the NASDAQ was around 13% per year after the big, this is,
yeah.
I mean, everything's dropped since then. But
Well,
so I
so
don't
if
know
you're,
why the benchmark that they chose to put alongside um, ARC Innovation in their own fact sheet. I don't know why it's the S&P
well,
500. You
because
think
the
it'd be the
NASDAQ
NASDAQ
doesn't
or the
make it look
NASDAQ
good.
100?
That's why.
Yeah, sure.
Yeah.
But yeah, I mean, another thing that I want to mention too, and this is something that I think is really important. We did a segment in the past about how share-based compensation has been used by these companies to fund a lot of their salary expense, right? So they offer employees shares instead of paying them in cash. Well, this was great for employees when the shares were going up every year. But now with the way the markets have, the way that the markets have declined, there's a big risk that a lot of these employees are going to be asking for payment, more of a percentage of their salary in cash as opposed to just shares. If that happens, you're going to see these cash burn numbers get even worse and potentially a lot worse. Or you lose employees, or you keep employees, but they're demotivated and less productive.
Yeah. Yeah, I mean, I think that BMO is trying to capitalize on a name here,
That's
and
what it is. Yeah.
I'm not sure if this name should be a name that is capitalized on. And if you were truly picking the most innovative companies in the sector over that 4 or 5 year period, you should have beaten significantly the Nasdaq, which
You should have, yeah.
would be home to some of the more innovative technology based companies. And the
Right.
fact that you haven't come close to beating it, over a 5 year period should then say that you don't really know what you're doing. I'm just
Well,
going to put it
and let's
way.
use the example of Zoom, because Zoom is the second biggest holding in the portfolio. So Zoom, I mean, I think Zoom right now
It's
fundamentally
actually first now.
Oh, is it first
Yeah,
now? Okay, so
I have the
those.
holdings up. Yeah,
Okay, so that the Tesla probably
it's
declined the
second.
price more. Yeah, so those numbers were as of September 30th, I think. So one of the top holdings, right? Top holding right now. So if you look at Zoom back during the peak, the stock then traded at 70 times sales. 70 times sales, and the valuation was so high, it was over like 150 times earnings, maybe even over 200 times earnings. I don't know exactly, because once it gets much over 100 times earnings, I figured there's not really much point in looking at the P ratio. That's not what the market's looking at. But 70 times earnings even would be what we would consider to be a relatively expensive valuation. And there was great stocks even in the peak, profitable companies, great companies that you could buy at that valuation. Zoom at that point was trading at 70 times sales, right? So, the writing should have been on the wall that the valuation was stretched and that there was an opportunity to take some profits. That would have been a great opportunity to get some cash injection in the portfolio. I wasn't tracking what she was saying about those companies. I don't know. But, certainly if you're going to make a comment on Zoom at the peak, it should have been that the valuation is high and stretched. Unless you
And
just
and
don't look at
and
valuation.
Zoom, as far as I understand, they keep investing in it. It's 25 times earnings now, which
Yep.
looks better, but the growth in constant currency even was just 7% in revenues in the last.
Yeah, no, growth has
quarter.
come way down, and now what you're going to get is you're going to get a lower growth rate. They'll probably bottom out somewhere, maybe this year, maybe next year, and then you're going to get a lower reasonable growth rate, because now it's a more of a mature business. It might be an attractive.
If it's going to trade, if it's going to have 5 to 10% growth in revenues, like, it should actually probably not trade at 25 times earnings. Maybe it trades at 15, 20. So, like, it could still have a re-rating of its multiple lower.
It could. I mean, we're looking at it closely. We think that it's a potential over the next year or so. But yeah, I want to see what the normalized growth looks like, and
then we have to pull out the stock-based compensation, because we're probably looking at adjusted earnings there. So, like, we're probably going off adjusted earnings. Like, the earnings on a GAAP basis are probably, the PE is significantly higher. So anyways, just something to keep a look at.
Yeah.